Good morning, everybody. Welcome to the Monday morning call. Hope you had a good weekend. Now it's a good time to, if you've got questions, concerns, things gone well, things going poorly, we could benefit from all of that as a group. So if you got those, put those in the chat box and we'll be happy to talk about it. So we'll get started here with a little couple of pointers. First thing is in the Outside the Box 2014, you might want to re-download that if you are planning on presenting here in the near future, because it's got the updated real benefits chart. And it also has a cleaner copy, or an embedded cleaner copy, or a smoother running copy of the MonPaw kettle video. So go ahead and re-download that if you're going to be presenting here in the near future. And also, in relation to that, if you remember at the end, we talk about the how we're compensated. So at this point, what we've been saying is that we're compensated. You know, you get it for free, folks, because I get it for free. And what you get out of it is you get all your problems fixed, or make sure you never have any problems, because the 21 points checklist will find that out. What I get out of it is this: is I get free software, I get free education, and I get free perks. So actually, we've come up with a more viable reason on why you're paid, and I just want to go over that script with you now. So the script for how we're paid now. Sure, you could say those three things, but you know, and that's going to work for some people. But some people want a more concrete reason. So the script for how we're paid now is this: we say, so folks, here's the thing. I actually, oops, let's go back here. Sorry about that, guys. So here's the thing, folks. You get all these things fixed, blah blah blah, and so you get it for free. But I get paid to do this as well by doing the 21-point checklist, and here's how. You all work with great advisors. You have great accountants, financial advisors, attorneys, property casualty agents. So you work with great advisors, and they're doing the big things. So what we do is we follow up and find the little things. And here's how I get paid for doing that. When you bring these little things to your advisors, to your banker, your broker, your accountant, your attorney, your financial advisor, when you bring it to them, they're going to say, holy cow, where'd you find this stuff out? You know, if we hadn't caught these things, it could have caused you huge problems, Mr. Client. And if it caused you huge problems, Mr. Client, guess what? It would have caused me huge problems, because I hadn't caught that. So where'd you find these things out? That you helped us dodge a bullet here. Where did you get this information? And folks, who will you tell them gave you the information? You tell them that I gave you the information. See, so I get paid. Here's how I get paid. By helping you avoid these problems and your advisors avoid these problems, they're going to find out in real life terms what I can do for them. So they're going to give me a call. And here's the fact. There's no advertising out there, whether it's on newspaper or magazine or radio or TV or me actually calling them up. None of that would work as well as I'm actually seeing your advisors, the best accountants, attorneys, bankers, brokers in town, seeing what I can do in real life and the problems that I can fix in real life. And they will call me up. So there's not a, this is the best advertising I can do. There's not, I can't spend money on advertisement that would give me the same results as helping you folks, because you folks are going to then convince your, or bring this information to your advisors, and those advisors are going to be convinced that what I can do, and they're going to call me up. So that's how I'm paid. So I love to do the 21-point checklist, because when I am able to find these things and help you avoid these things, my phone starts ringing off the hook from your advisors. Call me. So that's how I'm paid. So does that make sense to you guys? And Missy, I'm not sure if you can come in here. I don't know if I got the right screen up so I can see what they're saying.
I'll be right there.
So does that make sense to you guys where you can, and I need to see some yeses here, so. Nope, so I'm looking at the wrong screen. Sorry, guys. Be with you guys in a second. So I won't be looking at the screen. I guess Missy will have to answer for me. So that is more viable, and the guys that I've shared that with have used that at the events, have had, it seems to really resonate with the crowd. And so that's the way we're going to move. What everybody's saying. Thank you, Missy.
Okay, should be all good there.
There we go. Just a second, guys, while I get my screen. Ah, perfect. So yeah, I'm getting a lot of yeses. That makes sense. So that way we sound. It's a viable way of how we're paid. So you can go back and listen to this at your leisure. So now on with the show. So my real topic for today is this. You know, there's nothing more frustrating, guys, when you do a great job at the event or you get a referral and you get a bunch of people in and then you find out that they have lots of money, and then what happens? What happens? You get in front of them, you got, let's say, $500,000, and then you look at the assets, and what kind of assets are they in? Yeah, it's locked up. So it could be locked up in a number of ways, right? It could be locked up because it's in REITs. It could be in rental real estate. It could be locked up with all sorts of different ways. But the other way it can be locked up is what? For suitability purposes, it's not able to be moved because of, well, managed money. Managed money is easy to move, guys. So don't say managed money, because managed money is about as easy as you can move any money is managed money. So that's not locked up. Locked up is what? Where they have it in rental real estate and they have to sell the buildings to get the money. REITs, where they can't even get the money out. Or it could be where they've just moved all their money into fixed annuities not 6 months ago. Can you move that money? They moved all their money into fixed indexed annuities or fixed annuities 6 months ago. And somebody else said surrender charges. Guys, we've been moving big surrender charges forever. That's not a problem. If we can find a product that will take it due to suitability, getting a client to leave their product due to surrender charges is easy as pie. What the problem is that will a company take that money? So here's the thing. There are times that you run into people, and there's nothing more frustrating to have somebody say, take all my money, move all my money, I don't trust my guy. Take all my money, and you move it over, but how much you get paid? Zippo. So what do we use then for our second chance? Anytime that happens, we have one way to make them, get them in a better position and make us some money. So get the client in a better position and make us some money. So if all their money's locked up, what do we then present, guys? Anybody know? So you should never walk away from a client like this unless you present. Nobody knows? Oh, my goodness. Ah, thank you, Eric. Eric got it right. It's TRiiP. That's what we present. It gives us a second chance to get the money. Why? Because, Eric, do we? Why can we do that, Eric? Are we moving the whole lump sum, Eric? Just typing in there. No. All we're doing is peeling off a little bit off the top. And we use that to pay for the TRiiP plan. And we'll talk about the TRiiP plan in a second. But here's the thing. Here's why it makes sense to peel money off the top, especially if you've got any variable annuity with an income rider. Milevsky, who is really the most, and I'm not exaggerating here, the most respected expert by financial advisors in the industry today. And he did a study, and we talked about this probably 2 or 3 times in the last year. He did a study where he said anybody that has a variable annuity, the best thing for them to do is to turn on the income when? Now. Turn on the income now. He's run scenario after scenario and found that 99% of the time it makes sense. You come out ahead if you turn on your annuity, variable annuity, guaranteed income rider right now. So the only reason I bring that up is that we run into awful lot of variable annuities, and the math that he's using for VAs and income riders is the same for fixed indexed annuity in their riders. So because these insurance companies have locked themselves into these income riders, 9 times out of 10 it's going to be better off for the client to turn those on. So that means we can what? Well, somebody's asking what publication. Just Google Milevsky VA Shocker, and there you go. Google Milevsky VA Shocker, and there you go. Otherwise, we'll post it later, but that's all you need to do. So, and you see right there at the top, it says what publication says right there. From March 2013, issue of Research Magazine, February 22, 2013. So, what the TRiiP does is it allows us as a fallback, if all their money's locked up, to get them to buy a guaranteed universal life by just taking a little bit of income off the top to buy all the protection that a TRiiP can give them. So let's talk about why the TRiiP works so well. So there are 6 stimuli to the old brain, the reptilian brain, the emotional brain, and that is, first of all, The old brain is very self-centered. People are concerned about themselves first. Even, well, it's a sad thing, but even when it comes to our families, it's difficult. You actually have to physically prevent yourself from being self-centered even when it comes to your families. Contrast. We know this from school. Good and bad, new and old. We're born to do contrast. When you go to the eye doctors say, hey, does this one, or this one look better? Is that what they say? No, they say, does this one or this one look better? Does this one or this one look better? Does this one or this one look better? So they use contrast continually because we know that that's the way our brain works. Tangible output, something that they can see. And guys, we sell the intangible, and what's the TRiiP do? We sell intangible, and what does TRiiP do? What's a TRiiP presentation do to those of you guys that have done it? It takes the tangible and through a story, takes the intangible and through a story turns it into what? The tangible. Alpha and omega, and that is that they remember the beginning and the end. They forget everything in the middle. And the TRiiP presentation utilizes that. Visual stimuli. Why do we use an app instead of a bunch of numbers and charts and spreadsheets? No, we use boats because we respond to stories and visual stimuli and emotion. We actually put them in the boat and ask them what they would do. So that's why the TRiiP works so well for those of you who used it. So can I ask you a question, guys? Do people always do what's best for them? Do they? No, if people did what was best for them, how easy would our jobs be? All we would need to do is show that what we're offering is better for them, and they would do it. But people don't always do what's best for them. They rationalize away what's best for them. Do people believe they need life insurance? How about that one? We wish they did, because if they did, how much life insurance should we be selling? And then how self-centered are people? Unbelievably self-centered. See, the world revolves around them. That's why life. So why do you think if people are self-centered and the world revolves around them, why is life insurance so hard to sell then, guys? Why is life insurance so hard to sell? Well, somebody said they're never going to die, but that's not the answer, is it, guys? Because you're assuming if they're never going to die, that how does a person benefit from life insurance, guys? They have to what in order to benefit from it? They have to die, Eric, right? So good. You say, hey, you need this life insurance because if you have it, when you die, your family's going to do better. And what do they think? Well, how's that going to help me? That's what they're worried about is me. And you can guilt somebody into it, but do they gladly buy the life insurance, or guys, here's the thing I want you to think. If you truly loved your family, how much? If you put your family ahead of anything else out there, if you put your estate ahead of anything else out there, how much life insurance would you buy? How much life insurance would you buy? A lot. How many people do you run across that are way overinsured? Because that's how much money you would spend on life insurance if you really loved your family, is way more than you need. I never come across those people. I've never found anybody that's come across a person like that except somebody who sells life insurance. So we can't go in there and tell them how it's going to benefit their family, because instead they'll try to figure out the least amount they can buy to benefit their family. They're not going to look for the most they can buy to benefit their family. So we can't talk about how it's going to help their estate, because that's not going to help them. It's going to help their kids. How many bumper stickers do you say that read on the back of people's cars saying, I am buying lots of life insurance because and not going on vacations because I love my kids? Is that what the bumper stickers say? No, what do the bumper stickers say? I'm spending my kids' inheritance. That's what the bumper stickers say. And I've seen so many guys go in there and try to convince people that they should be worried about estate planning. Guys, that's a silly thing to do, because they don't care about their kids. They wouldn't care about who? Themselves. So the TRiiP, here's who the TRiiP applies to, because we're gonna actually the nice thing about the TRiiP is it's about them. It's not about their kids. It's about them, and it's about their spouse. So it applies to any couple with more than $100,000 of assets in between ages 55 and 72. And again, we apply it where? We apply it when they don't have enough, or when all their money is locked up. That's specifically where we'll apply it. And the benefits help them when? Right now. They don't need to die to get the benefits. They can get the benefits right now. And we'll explain that as we go through. And if they don't use the benefits today, then and only then will the survivors get it. So this is designed so that it applies and they get the benefits today. Now even better, Jerry and JV at the ECA showed me a new product that makes TRiiP even more powerful, because now TRiiP can be used and is viable for singles, and it removes the only weak link to TRiiP. So those of you that know TRiiP, what was the weak link to that? In order to benefit from TRiiP, what had to happen? In order for a couple to benefit from TRiiP, what had to happen? See, when I say it doubles people, one had to die. Exactly, Andre. One had to die. So here's the thing. TRiiP doubles their income, doubles their safety, doubles their growth without having to move their money with no additional taxes. How? Because when one spouse would pass, what would happen? Boom, life insurance benefit, which gave them a ton of money to put in their accounts, which doubled their growth, because we bought enough life insurance to double their pot of money. So we've doubled their growth instantaneously because we doubled their money instantaneously. And if we doubled their money instantaneously, what else have we doubled instantaneously? The income they could pull off of that money. And what else have we done? Yeah, some other you guys have other things talking about with the long-term care and health and all that. You're absolutely right. So we've doubled their growth instantly. We doubled their income instantly with no additional taxes. And did they have to move all their money to do it? No, they just pulled a little bit off the top. And yeah, Andre or Brahma, I would agree. Lifestyle. We doubled their lifestyle as well. And we overcame the loss of Social Security. And what? I gave them an inflation rider on their Social Security. So we did all those things. But one of them had to die. Now let me ask you a question. When I go back here and say, hey, it benefits them today, wait a minute, Mike. You said that one of them has to die to benefit. But now you're saying it benefits them today. So how would it benefit them today, guys? If one of them has to die, how would it benefit them today? See if anybody can get this. See if anybody's been a student of TRiiP. I'll give you a minute to figure this out because somebody might be typing a longer thing. If I said that one of them has to die to benefit, how can it benefit them today? Peace of mind? I'd go along with that, Mike. Policy loans. Well, remember with GUL, generally does GUL have a lot of money, cash value going into it, guys? Not really. So policy loans won't work for GUL, not the way we use it for TRiiP. Okay, Andre says they don't have to die. I would agree with you, Andre. But why? Here's why, guys. If I know, I have my pot of money here, right? And if I know my pot of money will instantly double eventually, what will that allow me to do with my pot of money? If I know that guaranteed my pot of money is going to double eventually, what does it allow me to do with my pot of money? Spend more, Andre. Exactly. That's right, Eric. Spend more and to have more peace of mind. It means if I spend a little bit more than 4% in a year, I maybe spend 8% in a year. If I spend more, I know eventually it's going to be replenished because, boom, when either one of the spouses dies, that pot of money is going to be instantaneously what? Right back to where it started from. Does that make sense? That's how it benefits them today. But the great thing is with this new product that Jerry and JV pointed out to me, it's awesome now because the only way that wouldn't work is what if they both lived to age 92 and they spent all that money? They could be what? In trouble. Broke. Exactly. So Jerry and JV pointed out a new product that eliminates that. So the only weak part, the only weak link to the TRiiP is now gone because they're going to show us a product which at age 85 actually pays out the death benefit to the client. So I'm going to quickly go through the TRiiP program again, and then I want to get them on the line here so they can walk you through this new product, which really eliminates the only problem with TRiiP, which what if they both live a long time? Now, we don't see a lot of couples living a long time, do we? But it could happen, and this new product eliminates that. So now this TRiiP now becomes the most perfect solution to all their problems in retirement available to them. And is it going to be you telling them that, or is it going to be them telling us that? So remember, the key here was that the median age, according to 2010 census, is what? Of widowhood or widower is what? The average person will lose their spouse or at a median age of 58.57. So that means that's a lot younger than we thought. So people are hit with a double whammy, right? They're going to end up having lose a spouse sooner than they thought, and the person who lives is likely to live what? Longer than they thought with how much money? less than they thought. So that's not a double whammy, that's a triple whammy. They're likely to lose their spouse sooner than they thought, live longer than they thought, with less money than they thought. That's a triple whammy. You add that problem together with a solution that doubles their income, doubles their growth, without any additional taxes, without having to move their money, you've got what? What do you got then, guys? You got a perfect solution to everything, to what they want and what they're afraid of. What they want is double their growth, double their safety, double their income, without having to move their money with no additional taxes. That's what they want, and what they're afraid of is dying poor. So it protects against all of those things. Do you get that? So the science of belief. The TRiiP is a 45-minute presentation, 3-part presentation using software based on motivational interviewing, which is what all of our things are, all of our presentations are based on. So part 1, we admit that their investment that they have right now could be good. Are we going to try to tell them that the investment they have now is bad? No, because they can't move it anyways, right? And nor do we want them to move it. So we're going to compliment them on that. But then we're going to get them to admit that what? It could be better if they lived in a perfect world. And then part 3 is going to be saying, you know what? We do live in a perfect world because we can make it better without you even having to move the money. So we talk about change. Then we have them own the change. And then we get them to say, I want that thing. So if I can jump in here to the, oops, uh-oh. So I have to get back into the presentation. Somehow I got kicked out. So I'm going to quickly walk you through. Oh, there it is. So if you go in here, TRiiP is down here, okay? It's going to hit TRiiP there. Then we're going to launch the software. It's loading up for us. Can everybody see that happening, hopefully?
Yep, it's loaded.
Okay, there we go. Good. I'm going to hit Bob and Mary. We got one put in here already. So just for explanation purposes, remember for when you want to have them pull money out of a particular thing, you can compare that to anything you want. Variable annuities, REITs, fixed annuity, stock portfolio, managed asset portfolio, bonds, CDs. Mutual fund, anything you want, you choose right here. And then whether it's qualified or not qualified, assumed growth rate, which we just use 5% for a balanced withdrawal. Life benefit is $150,000. We're not going to spend too much time on this because it's not about. You can go through a training video on the TRiiP. So I don't want to go through all of that because I want to get to this product that really makes the TRiiP sing. So I just want to go through. So these are the solutions. We got $150,000 death benefit. Okay. So we'll begin. So remember, the first thing we do is we talk about, we're going to use variable annuity, assuming that it has a, it's in it with a big surrender charge, so we don't want to pull it out. So we're going to talk about, hey, what can happen? Growth, income, safety, and tax protection. That's what we want from every single investment out there. So guys, I'm not going through the script, but those of you who have done this, who answers all of these white blanks? Who answers all of these white blanks? When who fills in this chart right here? For anybody who's done this before? Somebody said, Eric. Correct your answer, Eric. Who fills in these whites? So William got it, Brahma got it, Michelle got it, the client, Andy. Good job, guys. The client. So we ask questions, and the client will tell us. So we say, hey, how does your variable annuity work with growth? Does it work okay? Yeah, it's invested in the market, so it's going to go up when the market goes up. And then for most variable annuities, guess what? Yeah, we ask the client, Eric, and then we plug it in. You're right. So income, guaranteed income. Guaranteed safety is guaranteed income with the variable annuity because that gives us the safety, right? And then tax protection is just tax deferred. Now again, I'm not gonna go through the script here, but the client, we ask questions where the client will say, well, it's invested in the market. Well, it has guaranteed income. Well, it's safe because it has guaranteed income. Well, it's tax deferred. So we're gonna have the client tell us that. Then we're gonna say, but in a perfect world, every product is good and bad. So this is the good thing. What's the weakness of variable annuity? And they'll say, well, the limitation is market could go down or sideways and it could lose money. And income-wise, what's the limitation? Well, there's no inflation protection, right? It's a fixed payment. Safety-wise, the account value is not guaranteed. It's only the income that's guaranteed. Tax protection, well, the more you make, the more you what? Pay. So how could it be better then? Well, instead of invested in the market, what we'd have is what? Guaranteed growth. And then for income, what would be better than income? And we talk about the fact with lotteries. How many people take the lump sum with lotteries versus the income with lotteries? Almost all people take what? The lump sum. Why? Because a bird in the hand is better than two in the bush. And what would be better for safety? A big chunk of money, right? I'd rather have a gazillion dollars than guaranteed income for life, wouldn't you? And what's better than tax deferred? Well, tax free. Now, what would be the best though? That would be better. What would be the best? Well, if we could have guaranteed, or if we could be in the market and have guaranteed growth, right? Because what if the market went up 15% and our guaranteed growth was 8%? Would we be happy? No. So what we want is, if the market goes up 15%, we get the 15%, but if the market goes down, we have the 8%. I mean, we want market growth plus guaranteed income or growth. And what's better than income, guys? Well, a lump sum and guaranteed income. For safety, what's the best? Well, a guaranteed income and a big chunk of money. And we can't really get much better than tax-free, can we? So remember, we have a script where we ask questions, and the client, it's amazing when you do this. It's amazing when you do this that the client will get 80% of these right. They'll actually say the very words that we have typed in here. I've listened to tapes over and over and over again. It's amazing how when you ask the question, the clients actually will fill in these blanks for you almost exactly with the words that we have typed in here. So then we're going to say, well, that thing actually exists, and we take them through the boat story, remember? So we talk about 2 boats going through a jungle river, and do we know how long the trip's going to last? No, it could be 3 months, it could be 30 years. We don't know how long it's going to last. So on this trip, we don't know if there's any food stops. We don't know if there's any fuel stops. So we need to what? Pack a lot of food and fuel with us. So the first boat, what? The locals come, and locals have seen a lot of people go through the jungle river, and they've said, hey, you know what? We're willing to help you out. If you agree to pay us a half a fish out of 100 every month, a half a fish out of 100 every month, we'd be willing to, if you ever need help, if you ever need food, fuel, medical, any type of help whatsoever, we're there for you. We'll come and help you. And so the first boat captain says, well, that sounds like a good deal. For a half a fish out of 100 every month, yeah, I'll do that. That makes total sense. But the second boat, boat B, says, no, I don't want to do that. I've got good planning. I don't need to be gouged at a half a fish out of 100, if you call that gouging. I'm in control of my whole destiny. I'm not going to use your help. So then what happens? They go down the river, right? And, at first they find a lot of food. They find additional food every month. So boat B, guess what? He's happy because their food supply is growing and growing and growing. And boat A, is he happy? Sure he is, because their food supply is growing. It's just growing at a 0.5% slower per a month. But are both the boat captains happy? Are both the passengers happy? Yeah, they're all happy, right? Do you think the people in boat B are happier than boat A, or did either one of them even notice a difference in happiness? What do you think, guys? Do you think boat B is happier because their food supply is growing at a more per month? Yeah, it's the same, exactly. But then they go along, and can't people sometimes get sick when you're on a trip? So what happens with boat B? I mean, if somebody got sick on your boat, and it was a loved one, what would you do to get them well? I mean, if they're sick and they're getting sicker and sicker and sicker, what would you do to get somebody you love well? Or would you just toss them over into the river at night so nobody sees you did that? What would you do to get somebody that you love well? Almost anything, right? So you go to the locals and you say, I need help. We need medical help. Send us medical help. And what do the locals say? If you're in boat B, they said, hey, you didn't want any help before, so guess what? Tough duty. And they said, no, we'll do anything. We'll do anything. And so the locals say, okay, give us half your food, half your supplies, and we'll give you health assistance. And if it's a loved one, what will you do? Let me see. Throw them in the river or give them half the food supplies. What would you do? You'd go ahead and give them the half the food supplies. But remember, boat A, they had the agreement. So when they asked for help, what happened? The locals came and helped them, right? So which boat would you rather be in, boat A or boat B? And then we go along, and then we say, and then, you know what? We hit a rock, and we lose 1/3 to half our fuel. What's boat A? What's going to happen to boat B here? There's no gas. They call up the locals, and the locals say, you didn't want any help. We're not trucking any gas out here to help you. You didn't want any help before. So now guess what we have to do? We have to get out on those 100-degree days with 100% humidity and get out our oars and row. And at night, in the mosquito-infested night, we have to row. So what's that doing to your lifestyle? What's that doing to your stress level? What's that doing to your vision of the future if you're down to half to 1/3 of fuel that you had before? But in boat A, what they do? They called for gas, and what do the locals do? They came and filled them up. And as we go down the trip, guess what happens? Our food supply, less fish are being caught. Our food supply is going down. Maybe it got full of mildew or mold, so we're losing supplies. In boat B, guess what? they're out, right? They're out of supplies. Now how does that make them feel? But boat A, what they say, listen, locals, we can't pay you that 0.5% per month anymore because we don't even have enough to eat ourselves. And the locals say, you know what? Here's what we'll do then. We'll come and resupply you one last time. We'll give you a full boat one last time, and then we'll call it good. So now which boat would you rather be in, boat A or boat B? Of course, boat A. So when we first started, and then we just go through summary, right? We talk and we walk them through. So that, and that's what you do. What you're saying, you know, anytime you present something, you tell them what you're going to tell them, you tell them that thing, and then you tell them what you told them. In this case, we're telling what we're going to tell them, then we have them tell us what the story is, and then we have them tell us a summary of the story. Does that make sense? Now that was all about a boat going up the river, but the next part of the boats is what we say. Listen, that's obviously this is boats. But what we're talking about is retirement. And if you think about it, it's pretty much the same thing, isn't it? Because with retirement, do we know how long retirement is going to be? 3 months or 30 years? We don't know, do we? Do we know if there's going to be any future times when we're going to be able to hit a fuel stop or a food stop, or whether we're going to have to make what we have right now last forever? We don't know that, right? So what I'm going to show you here is boat B is your variable annuity, and boat A is your variable annuity with TRiiP protection. So let's talk about that. Let me go through here and say, now instead of a fish, adding additional fish every month, we're talking about the market going up. So we're adding money to our accounts, not fish to our accounts. So with variable annuity, guess what? Your account value goes up. And now, guys, you realize, can I hear some yes to this? You realize that I'm going through this very quickly, and I'm telling you these things, but what you're going to do with a client, you're going to ask questions, and they're going to tell you these things. Because if they tell you these things, that means they get it. It means they're buying into it. It means at the end they're going to say, I want this thing. So can I get a few yeses on this? You understand that what I'm doing here is not what you want to do. I'm just giving you a quick summary so we can get to this new product. Good. Thank you, guys. So obviously the account on TRiiP goes up 0.5% slower. So if your account goes up 0.5% slower, is that going to change your lifestyle? You're going to say, oh, geez, I can't buy that Jaguar I want to buy. I can't buy that mansion I want to buy. I can't take that trip around the world. Is it really going to affect your lifestyle at all if your account goes up at 0.5% slower? Then and they'll say, no, it doesn't. Exactly. So they're both happy, right? The account's going up, so everybody's happy. But what happens if somebody gets sick? Can something happen? And then we go through with the variable annuity that what? Long-term care or health problems. And we go with the fact that, hey, you know what? According to Mount Sinai Hospital, the average person will spend $70 grand on non-Medicare covered things not associated with long-term care. And you'll ask them, have you ever heard of things not being covered by Medicare? And they say, yeah. So that Mount Sinai Hospital in New York said that they found that an average person will spend $70,000. That means a couple will spend $140,000 just on medical needs not covered by Medicare in the last 5 years of their life. And that is not even talking about long-term care. If we add that in, we're up to $200,000. So what's going to happen if you're spending that kind of money in your account? It's going to go down. But remember with the locals, they were paying a little bit every single month. And the account value will remain what? Untouched, because the locals are going to come, or the TRiiP is going to come, and it's going to replenish your account or protect your account. So what are we talking about there, guys? One of two things. We're talking about either the Guaranteed Universal Life has a long-term care rider, or at the death of the ill spouse, what happens? Hey, Missy, do you see that question on the source for the Mount Sinai Hospital?
Yep, okay. I'm looking for it right now. It's actually out on the TRiiP plan software.
Yeah, it's on the TRiiP plan software,
yep,
guys.
It sure is.
Yeah, you get the lump sum, guys. Exactly, you get the lump sum. So if when the ill spouse dies, the surviving spouse gets all of the money replenished by the death benefit. If you have a long-term care rider, guess what? Not only is it protected, but you'll also get whatever left in a lump sum as well. So that's which one would you rather be in, the TRiiP protected boat or the variable annuity? And they always say what? For guys that have ever done this, does anybody ever take the variable annuity boat? What does everybody always pick? I've never heard of anybody tell me that they've done this and people have taken the variable annuity account. They always take the TRiiP. And no matter what, whether it's managed money, because all of these things are changed automatically, guys. Remember at the input where you could put in variable annuity, mutual funds, managed money, REITs, whatever you wanted to. All of these things are changed automatically for you depending on what asset you put in there. So then we go along and we talked about losing fuel. What are we talking about here, guys? Let's see some students at TRiiP. What are we talking about here? So on the jungle trip, it was loss of fuel. What are we talking about losing a third to half in real life? What are we talking about? Social Security, exactly, Eric. Perfect. So Eric is an expert and Lynn are experts on the TRiiP, and they know how well this thing works. So what we're talking about here is that when a spouse dies, you lose a third to half your income. Well, with the variable annuity, guess what? A third to half your income's gone, which means you have to start tapping into what? Variable annuity. But with the TRiiP, guess what? Spouse gets to hit the reset button, doubles their growth, doubles their income, doubles their safety, overcomes the risk to inflation, boom, instantaneously with the TRiiP. And then we go down here and we say, you know what? We get to a point where we can't afford this. We need to actually, the market goes down. We have to pull that income that we were paying for TRiiP. We have to actually start using that. Well, with the variable annuity, the account's going down because the market's gone down. We have to start pulling money out. But with the TRiiP, you know, we have to do the same thing. But then again, the spouse can hit what? The reset button, which doubles the growth, doubles the income, doubles the safety with no outmoving the money with no taxes. So the spouse gets hit the reset button because when their spouse passes away, boom, they get a big chunk of money, tax-free again, right? And here's the great thing. So we have them again tell us that it's better how many times? Is it better when the market goes up? Oh, shoot, I went too far. Going to whip through here again. Sorry about that, guys. I went too far there. Okay, so when the market goes up, which one is better? When the healthcare problems, which one is better? When the spouse passes away, which one is better? When the market goes down, which one is better? So they tell us which one is better all the time. So with the TRiiP, we get a 3-for-1 account. Why? Because we still have the account value, right? Plus we have protection for long-term care. Plus we have what? The doubling of the account. With the variable annuity, we just have the account value, so it's only one. So you get a 3-for-1 with the TRiiP. They say, but we have to make sure that we're doing the right thing. So let's overturn every single stone. So there's only certain things that can happen when we're retired. One is the market goes up, one is the market goes down, one is we don't need income, one is we do need income. One is we lose one spouse needs long-term care, and the other is one spouse passes. Can you think of anything else that can happen? Again, guys, I'm going through this very quickly so we can get to the product. So we go through the whole thing where with variable annuity, stock market goes up, the account goes up. And the TRiiP account goes up, but it goes up 2% lower. Why? Because they're going to lose. Remember, we said we're going to pull out 3% from their account to pay for this, and because of the tax way taxes affect it, their account's only going to go up 2% slower. So would it make a difference to them whether they make an 8 or a 6, a 10 or an 8? Do you think people are really going to notice the difference between an 8 and a 6 or 10 and an 8? There's no difference there whatsoever, and they tell you that. Plus, you get $150,000 tax-free, which doubles your account value tax-free, which more than doubles it because why? No taxes on that. So it's a 3-for-1 difference. You get the account value, plus you get the $150,000 tax-free, plus you get $150,000 to the kids tax-free. Why do the kids get $150,000 tax-free, guys? At the death of what? Second spouse. Stock market goes down, the account value goes down. This one goes down, the TRiiP qualified one goes down, again, 2% lower. Why? Because the 3% you're pulling out as affected by taxes goes down 2% lower, but you get $150,000 tax-free, and it's still 3-for-1 difference. Now, if you don't need income, same thing happens. Account goes up 2% slower, but you still get the $150,000 tax-free. You still get a 3-for-1. Now, if you need income, well, you're going to withdraw the 3% from here. You withdraw the 3% from there, and you get somewhat less than the $150,000. So let's say they can no longer afford to pay for the Guaranteed Universal Life. What are the things they could do? Well, first of all, you can see with this new product, it's a no-brainer what they're going to do. But let's just talk about before we have this new product, what could you do? Number one is the kids could step in and say, what? I'll pay for it. Why would the kids want to pay for it? Because they're likely to get 3 times the value by paying for it. So they'll pay for it so they get $300,000 instead, or the $450,000 instead of what? Just $150,000. They get 3 times as much money. Of course they would step in and do that. Or they could let it go, or they could cut the death benefit in half where they could afford it, or they could use what? A home, reverse mortgage, or they could do what? Life settlement. You can see with the new product, life settlement would be, boom, no-brainer. So if they reduce the death benefit, they get someone less than $150,000. And if they cancel it completely, did it do what it was designed to do, which is to protect them? It was insurance. So did it protect them while they're paying for it? Yes. So they actually have 6 different choices if they ever need the income. One spouse needs long-term care. Account value is draining. Account value is draining, but they get $150,000 tax-free and possibly even a long-term care benefit. So they still get a doubling of the account. So I'm going through this very, very quickly, guys, just because we want to get to the product here. So one spouse passes. Guess what? They lose a half to a third of the Social Security, which means their account's going to be draining. But here, they get $150,000 tax-free, which is going to go a long way to giving them another 7-10 years of what? Social Security income, or replace Social Security income. And the nice thing for you guys is what? What do you get when the spouse dies? What do you get when the spouse dies, guys? Hello? Who are they going to call when the spouse dies? You. What are you going to do with that? Access to the assets, Peter. Exactly right. Money to invest. Exactly. So with that said, that was just a quick overview for those of you that haven't really looked at this before. This is an awesome tool if all their money's locked up. And the only downside is, what if both of them live a long time healthily? So the new product that Jerry and JB showed me is awesome to show that. So Missy, can you turn over to JB and Jerry so they can walk through that product?
Okay, Jerry, you should have it now.
All right, thanks a lot, Missy.
Yeah.
So thanks for the presentation, Mike. The product that we're going to talk about today is the AIG AG Secure Lifetime GUL. And for those of you who don't know what a GUL is Guaranteed Universal Life. So that's guaranteed no lapse coverage. So you don't have to worry about the policy lapsing out because indexes don't perform. It's a guaranteed death benefit. And along with that, it's guaranteed premium. So you know what your premiums are going to be every year. You're not worried about markets performing because your death benefit is guaranteed. And then specifically with this product, as Mike alluded to, this is a special product that's got a little bit different niche. So it's life insurance you don't have to die to use. And traditionally, a lot of times when we're using GULs, we'd use something like a John Hancock with a long-term care rider or a Lincoln GUL. And specifically why we like the AIG GUL is because you don't have to die to get the benefits. And it's not just the long-term care benefits. Like Mike said, if we have a death benefit of $300,000 and we end up living too long, we actually get to use that entire death benefit now when we're alive. We can accelerate that death benefit, and it's not for long-term care needs. We get to accelerate it. The only requirement is being age 85, and we can use that money for anything we want, whether it's a new car, a new pair of shoes, or whatever. That's money that you get to have. And Jeff Van Grinsman's just going to go over this product and get you guys the details and show you how it works. Yep. Just a second. Here we go.
Okay, so can you hear me, Missy?
Perfect. Yep.
Yep, we
Okay,
sure can.
fantastic. So as this this slideshow kind of correlates with the TRiiP plan itself. So as it says, there's one of three things that are going to happen. You're either going to die too soon. The next thing that would happen would be you live too long, or the third thing that would happen is you get sick along the way.
Can I jump in there, Jeff?
Oh, sure.
Yeah, guys, what they're saying, you'll see this, and we have a question. We'll work at age 61. Yes, this can be bought. This is when you would buy it is when there's 55, 60, 65, 70. But the only way the death benefit can be turned into cash is at age 85. So with TRiiP, the only problem to TRiiP is that if they both live to be ripe old ages, then they would have then the TRiiP wouldn't work because they're waiting for one to die. With this, in this case, this death benefit turning into cash happens at age 85. So that's age 85. You don't buy this at age 85. The death benefit turning into income turns on at 85. So this can be bought. What are the ages they can be bought at, Jeff?
Up to age 70.
There you go.
Okay, so it's often thought that the three traditional things that life insurance are bought is for paying off the mortgage, making sure that children can go to college, and then ensuring replacing lost income due to the death of a primary breadwinner or the other spouse. One additional thought emerging is that during retirement, and this correlates with the TRiiP, is that one of these three things that will happen, that you get sick, live too long, or you die too early. And this is where this product would be. You die too soon, live too long, or get sick along the way, which is just like the TRiiP program. So we'll talk about this lifestyle income solution here. And this has the three ultimate package of benefits. So the first thing is the asset protector. Basically, the way this works is, once again, this is a GUL product, so this is full underwriting. It's not like a simplified issue, so it is full underwriting. We'd take out two policies, one for the husband and one for the wife. And basically, this is going to protect the client from dying too soon. The premiums are real competitive. When we ran this against the GUL against Hancock and Lincoln, it's very competitive. So it's not priced much higher at all. In fact, dollar for dollar, they're almost identical. But in addition to just providing the death benefit, the premium you pay, you also get these additional, the guaranteed death benefit. There is a guaranteed cash value. Now, it's not a lot of cash value, but there is actually, believe it or not, a little bit of cash value built into this policy. The enhanced surrender value, and then the last thing is there's a 50% return of premium in year 20, and I should say then the last thing is there's a 100% return of premium at age 85, and that's what we'll talk about in a minute here.
And let me step in there real quick, Jeff, too, as well. So, you guys, when we're talking about actually taking out money at age 85 through lifestyle income solution, we're not talking about taking cash value out of the policy. I'm actually saying you get to accelerate the death benefit, use the death benefit now, just like you would if this was a long-term care rider and you're accelerating the death benefit. And then on the 50% return of premium, how that works is, let's just say someone's 55 years old and they get in the policy and they get to age 75, they can exercise return of premium on the policy, and then they'll get 50% of their premiums that they paid into that point. And then also a note that's not in here is if you were to use a survivorship GUL, that's in year 15 you can get return of premium, and that's 100% return of premium when you're using the survivorship version of this. Go ahead, Jeff.
No, wait, let me ask you a question here.
Yeah.
Are they getting at age 85 100% return of premium, or are they getting 100% of the death benefit?
100% of the death benefit.
Yeah.
So the difference is, yeah, go ahead, because that it's saying 100% return of premium. So, but we're saying that if the death benefit was $350,000, they would get not the return of premium, but they would get this or what? The death benefit spread out over the death
benefit. That's correct. You're going to actually get the death benefit because your death benefit is going to be more than the premium that you put in the policy. So you get the death benefit at age 85. You can turn on the death benefit, and you get that paid out over 10 years. So it's a 10% per year.
So what is this 100% return of premium then?
They're just saying well, you could choose the 100% return of premium. I think it's just their play on words, but you actually get the whole entire death benefit.
Okay.
Okay, so basically, it's, as it says, create an additional income stream in retirement while maintaining a guaranteed death benefit. Let's see, reduce the death benefit and premium while maintaining the original coverage, withdraw cash value, and terminate coverage and surrender value for the policy value, or exchange the policy value for one that better suits the current need. If your clients are going to generate all that, because it does generate some cash value, it says they wouldn't likely need to participate with those withdrawals without abandoning the long-term guaranteed death benefit protection. Basically, this policy, there's the flexibility, basically, and that's what we're looking for. So you can access the cash value and preserve the proportional guarantees and enhance the future flexibility, which is unique among the GUL products. Most of the GULs are stripped-down products that don't have a lot of features or very limited features to the products. Let's see. If you live too, now let's talk about if you live too long, and that's using the Lifestyle Income Solution rider. And basically the way this works is, if you're going to give a seminar, they'll say, now everybody who's saved too much more money than they need, please, they can stand up and leave the room. Well, tongue-in-cheek is nobody would stand up and leave the room. According to the U.S. Census Bureau, they said by the year 2050, there's a projected 88.5 million people at age 65 or over. That's more than double the number in, whoops, oh, went too far.
Yeah, keep going.
That's more than double the number in 2012 or 2010. And the longevity statistics are equally compelling when you consider that for a 65-year-old married couple, there's a 50% chance that one of you will live to age 94 and a 10% chance.
So guys, here's the triple whammy, right? 58.5 is where someone's likely to lose a spouse, but the surviving spouse has a 50% chance of living until age 94 on less money than they thought. But that's occasionally people are going to both live a long time, and that's where this comes in.
Yeah, and those were consistent with the numbers that Mike had in the TRiiP video there also. And this is just that spending more time in retirement while not generating income, that there is, because you're not having income, this would be a way to draw some income out, basically. Okay, let's see, think about what may contribute to the possibility of outliving your retirement income. There's debt, Social Security uncertainty, historical low interest rates, health care, political uncertainty, that you didn't save enough, rising income rates, stock market corrections. Once again, these are consistent. This slideshow was sneaky in the sense it's very alarmingly consistent with the stuff that Mike had talked about in TRiiP, things that can go wrong in life. And so that's why they say the lifestyle income solution can come to the rescue. Your clients need life insurance in the pre-retirement years, but instead of purchasing low-cost term insurance, they can upgrade to a high-quality permanent policy. And then accelerate up to 10% of your death benefit per year. And that's where Jerry had mentioned alluding at that age 85. So if it was $100,000 of death benefit, you'd be getting $10,000 a year for the next 10 years. And
does anybody have a question? Do you get the value of that? Does this work when you get 100% of death benefit policy terminates? That would be big taxable event and pay tax on the difference between the premiums paid and the death benefit, or is there enough cash value left over? So what is the taxation of the death benefits? Do you guys know? If they pull this out as income, they get their premiums back first of all at no tax, right?
That's right, up to cost basis, and then
Yep.
anything over that. So if you paid in if you had a $300,000 death benefit and you paid in $150,000 into the policy, that $150,000 you won't be paying taxes on, but the $150,000 over what you paid in would be taxable.
And remember, guys, if you're to a point where you need this cash, what tax bracket are you in? High or low, or no? You're in low or no. So keep going.
Yeah, and like you alluded to, the problem with the TRiiP always was before, or I shouldn't say the problem was, is that many times you could get to the very end and you've paid for one or two policies for 10, 15, 20 years and there was no value at the end, or the first spouse passed and then the surviving spouse would either have to continue that or have the children continue making payments. Now the surviving spouse would, in addition, collect the death benefit from the first husband, assuming the husband passed, and then she could in turn cash in her policy as a living, through this living benefit.
So now we've gone, guys, from doubling their income, doubling their growth to what?
Tripling or quadrupling the growth.
Tripling or quadrupling their growth or income. So yeah, and we're running at 5 minutes, guys, and you guys got a lot of questions. So the guys with questions should call JV afterwards to answer those questions.
Yeah,
we won't have
yeah,
time.
we can run an illustration, and the guys that have ran Hancock or Lincoln in the past, we'd be happy to run another illustration side by side so you can see this.
The main thing I want you to see with this product, guys, is this. Is that the weak link we had is what if both spouses, because the TRiiP is awesome. How big of a hero will you be to a client when their spouse dies, they lose that Social Security income, or a spouse gets sick, and when they die, they get this big lump sum? How big a hero are you? The only weakness to it was what if they both live a long time? This takes care of that, because if they both live to age 85, boom, they could turn even if they were spending more than they should, they turn these death benefits into income, and they're back to where they started again, because that takes them all the way to age 95. So that was the only weak link if they both lived a long time, and this policy removes that weak link. Now there is zero reasons why somebody wouldn't want to do a TRiiP if they could get qualified. Now the question is this: what if they can't get qualified, guys? So I'm going to kind of, because we're running late here, Jeff, you got to the point I wanted you to get to. If they have questions, they can call you, JV?
Sure, yeah.
Super. So guys, here's the thing. What if you do this and they don't qualify for it medically? Are you out? Not necessarily. Why? Because once people have been shown. What if you're on a ferry and the ferry goes down, and they're passing out life preservers. I want a life preserver. I want a life preserver. And then they run out a lot of life preservers. If they then offered you, say, a cooler that you could at least hold on to, would you say, no, I don't want that? Not as good as a life preserver, but would you grab anything that floats at that point? Or would you say, no, if I can't have a life preserver, I'm out. No, you grab anything that floats, wouldn't you? So if they are not qualified medically, you've already showed them that, wow, I need some sort of protection. What if I can only get it on one spouse versus the other spouse? They'll take it. What if I don't qualify for this? There's other things they could do with their money. I mean, so even if they don't both qualify, they'll want, after they go through the TRiiP presentation, they'll say, I want this, I want this, I want this, and then they'll be satisfied with whatever you can get them, and JV and Jerry are excellent at being creative, finding other solutions for people at that point. And guys, I got a couple of questions here about survivorship policies. Guys, do we ever use survivorship policies for TRiiP? No. Why not, Eric? You're right. Because this is to protect who? The spouse. This is for living. This is a benefit that people get while they're alive, not while they're dead. Survivor benefits are for what? The family after both spouses die. We're not talking that people aren't interested in protecting their kids. People don't want to protect their estates. We think they do. Who do they really want to protect, guys? Who does a husband and a wife really want to protect? Themselves and each other. They're not worried about their freaking kids. Do you get that, guys? So let's stop talking about survivorship policies. Your survivorship policies are, and I had lots of people putting survivorship policies in. That's not what people want. It's what a guy wants to sell somebody because they think their client is worried about their kids. They're not. Do you get that? Maybe when they have $50 million, but not when they have $500,000 not worried about the kids. The kids get what? Whatever's left over. So the main points I want you to pull from this is what? If all the money's locked up, you need to show them a TRiiP. The TRiiP has a high percentage closing ratio because the client, when you learn it, the client actually fills in those blanks for you. And when they tell you they want this thing 50 different times in 45 minutes, about once a minute, guess what? They want it. And then the only weakness we had to the presentation was, what if they both lived a long time? That really wasn't a weakness because people still want this thing because they even admit they don't see a lot of married 85-year-olds walking around. It's usually what? We lose a spouse early and then the other spouse lives a long time. What we say is what? I don't see a lot of poor couples. I just see a lot of what? Widows, poor widows and widowers. Why? Because they lost a third to half their income and they're living longer on less. But if that so happens that they're worried about, hey, what if we live a long time? Boom! Taken care of with this new AIG product, because at age 85, they can turn the death benefit into what? Income. And when you calculate what their guaranteed growth would be, the difference between the premiums they put in and pulling the death benefit out, it's a decent rate of return, guaranteed. So that's what I wanted you to pull from this. If you got specific questions, please give JV a call, and he can walk you through those things. But do you get now why you should never walk away from somebody where you think all their money's locked up? You need to at least fall back and show them this and let them tell you whether they want to do it or not. And even if they're not medically qualified, there's other things that we can do. Does that make sense to everybody? So this is a way to make $3,000, $4,000, $5,000, $6,000, $7,000 on a case where before you had to what? Walk away because all their money was locked up. Does that make sense?
Jeff and Jerry, can you guys quick give your contact information so that anyone that wants it can call you?
Yeah, you can get a hold of Jeff and I here at 877-941-9710. Again, that's 877-941-9710. And Jeff's email address is jeff@ECA, Echo Charlie Alpha, marketing.com. And mine is jerry@ecamarketing.com. So if you have any questions, feel free to give Jeff or myself a call, and we're more than happy to walk you through it and help you out with the case that you're working on, a TRiiP case.
Guys, I'll just tell you straight out, I don't see enough people presenting TRiiP for cases where they just walk away from this crazy. Don't walk away from a case. Show TRiiP. If you watch the video from TRiiP, you're not going to have anybody that's going to say no at the end of the TRiiP. And now with this new product, it's a complete 100% no-brainer, even for clients that can move money. Taking income and buying some TRiiP makes sense, and it's a great way for you to provide value to your clients and make a little income on the side. So was this a worthwhile call, guys? Good. Awesome. So have a great rest of the week, and we'll talk to you all on Friday. And guys, I'm not seeing enough people on that Friday calls, Let's get more people on those Friday calls. That's the most important call we do, because that's the skill that's going to allow you to make all the money you want to make, getting on their side. Let's get on those Friday calls. Thanks, everybody. Have a great week.